Welcome to the 2018 fourth quarter economic update. Quarter 4 finished 2018 with poor returns for equity investors. As this chart illustrates, large fourth quarter declines negated previous market record highs in 2018 and resulted in single-digit negative returns for the year. After a quiet 2017, volatility returned to equity markets in a historic way in 2018. While the nightly news and financial tabloids like to use harsh and scary language to attract viewers, oftentimes their quick views of equity market performance include media magnification, which is the act of making something look larger or more important than it really is. Currently, equity markets are volatile and have experienced a correction. Some are even in bear market territory, but not a crash. As our chart shows, most corrections are not market crashes. If you recall, the October 19, 1987 market drop of 508 points was a 22.6% decline. That clearly is a market crash. The same percentage decline for the Dow, if it happened on January 2nd, 2019, would have been over 5,000 points, which clearly did not happen. The Fed raised U.S. Fed fund rates to 2.25 to 2.5 in December and could raise interest rates again in 2019. 3 years ago, the Fed moved away from the near zero rate that had been in place since the days of the global financial crisis. In December, the Fed raised interest rates for the fourth time in 2018 to move the target range for its benchmark fund to 2.25% to 2.5%. As of that session, Fed officials forecasted 2 more hikes in 2019, down from 3 rate raises previously projected. Key economic data indicators are still reasonable. City National Rockdale indicators show widespread strength and continue to signal moderating but still healthy U.S. economic growth ahead. Analysts suggest 2019 will have positive equity returns. About 41% believe stocks are correctly valued, and nearly 60% felt current valuations look cheap, which indicates an overall bullish sentiment. Investors need to still be very cautious and watchful. Completely avoiding market risk may not be appropriate for most investors, and today's traditional fixed rates might not help you achieve your desired goals. Most investors attempt to build a plan that includes risk awareness. Often this can lead to safer but lower returns. Traditionally, bonds have been a nice hedge against market risk, but with interest rates projected to rise, investors must be extremely cautious. Focus on your personal goals and call us if you have any concerns. We'll review your personal plan at our next review meeting. During confusing times, it is always wise to create realistic time horizons and return expectations for your own personal situation and to adjust your investments accordingly. We try to understand your personal commitments so we can categorize your investments into near-term, short-term, and longer-term. Equity markets will continue to move up and down. Even if your time horizons are long, you could see some short-term downward movements in your portfolios. Make sure your investing plan is centered on your personal goals and timelines. Peaks and valleys have always been a part of financial markets, and it's highly likely that trend will continue. Investors need to be prepared. Market volatility has caused concern, but panic is not a plan. Market downturns happen, and so do recoveries. This is the ideal time to ensure that you fully review and understand your time horizons, goals, and risk tolerances. Looking at your entire picture can be a helpful exercise in determining your strategy. Thank you for taking the time to listen to this presentation. We appreciate the opportunity to assist you with your financial needs.